We just talked about the idea that the real estate market is not about ups and downs. It's about higher than average appreciation versus lower than average appreciation. But in general, it's always going to appreciate. We talked about the idea that in the short term, medium term, we're looking at crazy appreciation, 8 to 10%. You called on this show. We're going to make a little segment about that to keep you honest. And we talked about the idea that this is the opportunity as it presents itself today it's a window in time. Like we are in a window in time where everybody is able to eat, and those that eat now, may not be able to eat in the future, but you guys are uniquely positioned to continue to service it in comparison to the rest of the industry. So where are we in the market cycle? Like what is the final prognosis of where we are with the market cycle? Is it as easy as saying buy rating, sell rating? Is it a bull bear? Like how do you want to kind of put a stamp on like what the snapshot of the market cycle is now that you've explained all this stuff?
Well, it's very clear that we are in a higher than normal home price appreciation phase for this market cycle. And when you capitalize on higher than normal home price appreciation, along with lower than normal price of debt, you can create an incredible amount of generational wealth. And the writing is on the wall, like the numbers. If you believe that prices are going to go up in the future and you believe that interest rates at some point in the future are going to be higher than what they are today, it would be impossible for cash flows to not go down. You know what? I probably shouldn't say that. It would be possible, but generally speaking, rents are not going to rise at a rate that's higher than home prices. So if you're looking at this and you're thinking, what can I do today to maximize my wealth? It would be buying today. If you have a pile of money that you've sort of set aside for rental property, this is, I think, the biggest opportunity, because, we don't all have money that we can just kind of bring to the table and buy 10 rental houses. But for some of us, we have money in the stock market, or we have money that's sort of set aside and we're saying, you know what, over the next 3 years, over the next 5 years, I want to go ahead and I want to buy one house a year for the next 5 years. I hear this a lot. And you have the ability to do that today. It is very real to me that your money would be best served to take that same pile of money that you were planning on investing in rental properties and doing it now, and then stopping. This isn't about buying more houses than you had planned, but taking that amount of houses that you had planned to buy and doing it today, because your interest rates are going to go up in the future. We're seeing that home prices are going to go up in the future, and your 5 profit centers will be better today than they will 1 year from now, 2 years from now, 3 years from now.
I like it, man. I'm gonna reframe that in saying that, because the way that I think of it in asset classes. I think of it as I subscribe to this like black swan theory of investing, where I want 85% of my money to be somewhere that I think is going to be consistent, that isn't going to be very volatile. And then I want to gamble with 10 to 15% of it, like, and take moonshots. So I take this and I think, man, so it's time for me to get my butt in gear and make sure, and because there is now this snapshot where this asset class that happens to be long-term stable, cash flow positive, plus upside, plus I happen to know who to call at this point in time. I take this as, man, I need to get all my financial ducks in a row in 2021 and see exactly how much that I thought that I wanted to put in index funds and T-bills and now rental income properties that has come into the mix. I take it as it's time to really just get my ducks in an order and try to acquire as much of this under the current cash flowing conditions as possible.
Yeah. Okay. That's what we talk a lot about with current clients and with people who are just starting to invest with us. We map this entire process out, and it's really cool because we're able to take your goals and whatever it is that you want to accomplish, we're able to assign a dollar figure of income that you need to earn from that. And that helps us understand the number of houses you need to acquire. And then we map this out over the next 5 years, 10 years, whatever your horizon is. And then we take the extra step and we say, all right, well, what would your cash flow be if we bought twice as many today than we did in the previous scenario? If you had 5 houses over the next 5 years, you bought all 5 year one, what would your cash flow be? What would your home price appreciation be? And we factor in, what would rising interest rates do to this? What would home price appreciation do to this? And we're able to show how your cash flows go down over time, and the appreciation or the equity that you earn goes down over time because you missed out on some of it. So that's really what it is. And we offer that for all potential clients that are out there that want to have a plan in place, whether you buy with us or not. I think everybody should have this plan in place. And for current clients, like you are minted, Pablo, as a brand new JWB client, it's something that we do and we review routinely and at least once a year or whenever clients request it. So yeah, I'm with you, man. I think this is the time. I've been singing it from the rooftops for a long time here, and I've never been more loud about it than I am now. And it's because I believe in my heart it's the thing to share with our clients.